Who doesn't like the idea of earning money just by owning a stock? A quick glance at a phone screen, and a company like the Coca-Cola Company has already deposited cash into an account. No extra work, no selling, no effort. The money simply appears, and that feeling is hard to ignore. But on the other side are the so-called boring investors, the ones who argue that investing should stay simple. Buy the entire market, stay patient, and hold for 30 years. That's the entire strategy. So which approach actually makes more sense? This comparison breaks down dividend investing and index funds, not just by returns, but also by the psychology behind them, real retirement scenarios, and what each strategy truly feels like over time. This is Wealth Logic, where investing concepts are explained in a simple way. But first, a quick disclaimer. This is not financial advice. So what does it actually mean when a company pays a dividend? Buying stock in a company means becoming a partial owner, even if it's only a tiny piece. Some companies, usually large and well-established businesses, generate so much profit that they can't efficiently reinvest all of it back into growth. Instead, part of those profits gets returned directly to shareholders. That payment is called a dividend. It's real cash deposited straight into a brokerage account. Companies like the Coca-Cola Company, Johnson & Johnson, and Procter & Gamble are classic examples. Many of them have paid dividends for decades, and some have increased those payouts every single year for more than 25 years. Those companies are known as dividend aristocrats. Now, the number most people hear about first is called dividend yield. It's the annual dividend divided by the stock price. If a stock trades at $100 and pays $4 per year in dividends, that's a 4% yield. Simple. But this strategy doesn't require picking individual dividend stocks. Another option is investing in a distribution ETF, a fund that holds a basket of dividend-paying companies and distributes regular income to investors. Instead of depending on a single company, the income comes from dozens, sometimes hundreds, all at once. And just like individual dividend stocks, those payments appear as cash in an account regularly. So, what are the real advantages of dividend investing? The first is income without selling. In retirement, there's no need to liquidate shares because the portfolio itself generates cash flow. That becomes especially powerful during a market downturn. Even if the portfolio drops on paper, steady dividend payments can help investors stay calm and avoid panic selling. The second advantage is psychological stability. Regular cash payments help investors stay committed and avoid emotional decisions during market crashes. Then there's dividend growth. Strong companies don't just pay dividends, they increase them over time. As inflation rises, income can rise alongside it, making dividends a potential hedge against increasing costs. Now, there are also major downsides to dividend investing. Many portfolios become heavily concentrated in sectors like utilities, consumer staples, financials, or real estate. That limits exposure to the broader economy and can cause investors to miss higher growth sectors. Dividends are also not free money. When a company pays a dividend, the stock price usually falls by roughly the same amount. No extra value is created. It is simply a portion of the investment being returned as cash. In taxable accounts, dividends are also taxed when received, even if they are reinvested. That creates friction, which slows compounding compared to more tax-efficient strategies. Then there's the danger of chasing high yields. Yields of 7, 8, or 9% may seem attractive, but in many cases, those yields signal underlying risk. The company could be struggling or close to cutting its dividend, and chasing those yields is one of the fastest ways to run into trouble. Now, consider index funds. The concept is simple. An index fund tracks a market index like the S&P 500, which represents 500 of the largest companies in the United States. Buying into one of these funds means instantly owning a small share of all those companies, creating automatic diversification. The philosophy behind this strategy is straightforward and supported by decades of data. Most professional fund managers fail to consistently outperform the market. So instead of trying to pick winners, the strategy is to own the entire market. The idea was popularized by John Bogle, founder of Vanguard, in the 1970s, and over time, The data have strongly supported that approach. So what makes index funds so appealing? The biggest advantage is diversification. Because an index fund holds a large number of companies, poor performance from a single stock has a much smaller impact on the overall investment. However, diversification varies between funds. The S&P 500, for example, focuses entirely on the United States, while global index funds spread investments across multiple countries. The easiest way to understand this is by reviewing a fund's fact sheet, which shows allocations by company, sector, and region. Another major advantage is cost. Some index funds charge extremely low fees, sometimes as little as 0.03% annually. By comparison, actively managed funds often charge around 1%, a difference that may seem small but can significantly reduce long-term returns. Index funds are also highly tax efficient. Since they trade less frequently, they create fewer taxable events, allowing investments to compound more effectively over time. Historically, they've also delivered strong returns. The S&P 500, for instance, has averaged roughly 8 to 9% annually over long periods. Still, past performance never guarantees future results. But there are downsides as well. One of the biggest is the lack of a consistent income stream. In retirement, a portfolio may hold substantial value, but funding daily life often requires selling shares. During a market downturn, this can feel extremely uncomfortable and conflict with many investors' instincts. There's also something known as sequence of returns risk. If retirement begins just before a major market decline, selling assets to cover expenses can lock in losses at the worst possible time. It's a real risk that's often underestimated. And finally, there's the simplicity of the strategy itself. Index investing is intentionally boring, but maintaining discipline with a boring strategy can be surprisingly difficult. When markets fall sharply, there's no steady income providing reassurance, only declining numbers on a screen. And that's often when investors are tempted to sell at the worst possible moment. Okay, but what does retirement actually look like under each strategy? Assume the goal is to generate $50,000 per year in retirement income, excluding taxes for simplicity. Under the dividend strategy, the portfolio must produce $50,000 in annual dividends. With a realistic 3.5% yield from quality dividend stocks, that requires roughly $1.4 million invested. The income arrives automatically, and even during weak market years, the dividends often continue. The trade-off is that the portfolio is typically less diversified, and over decades, significant growth potential may be sacrificed. Under the index fund strategy, the approach relies on the 4% rule, a widely studied withdrawal method suggesting that 4% of a portfolio can be withdrawn annually in retirement with a low probability of running out of money over 30 years. To generate $50,000 per year, the required portfolio would be around $1.25 million, slightly less than the dividend approach. Because the investment is spread across the entire market, the portfolio tends to grow faster over time. But generating income requires selling shares, and during market downturns, that can feel psychologically brutal. The major risk is the sequence of returns. A severe market crash early in retirement can cause lasting damage, which is why retirement withdrawal planning becomes so important. So, what works best? In the end, it comes down to the strategy that can be followed consistently over the long term. But purely from a numbers perspective, index funds tend to come out ahead. They offer lower costs, broader diversification, and historically stronger total returns. That's what the data continues to show. Dividend investing, however, often wins on the psychological side. The biggest mistakes rarely come from choosing one approach over the other. They come from behavior, panic selling during downturns, chasing high yields in risky companies, or never investing at all while searching for the perfect strategy. If this was helpful, support the channel by liking the video. It makes a bigger difference than most people realize. And for a deeper dive into topics like dividend reinvestment or the 4% rule, share it in the comments. Thanks for watching and see you in the next one.